Welcome back to EDS, and in this video I'm going to show you one trading tactic that's very rare to see being done right and being done step by step where you can follow along. So the first thing you want to do is open up your brokerage platform. We are going to be selling options contracts or writing the contracts. We're going to get very high probabilities of success with high returns on our capital. So what you want to do is open up your brokerage platform and go over to where you can see a watch list of stocks. I'm just going to be using this 52-week near low watch list that's pre-made by our broker. This is just going to show us a list of underlyings that are currently near the 52-week low, and we're gonna make a small directional assumption, assuming that price will mean revert a little bit and move higher, seeing as we're at the lows for the year. This isn't always the case. However, it doesn't really matter, and I'm going to show you why in just a second. So once you've got your watch list open, you want to have IV rank on the watch list, and you want to order it from high to low. Anything with an IV rank of under 30, you don't even want to look at it. But fortunately for us, everything on this list right now has an IV rank of over 30. Over 50 is considered very high, over 30 is considered high. I like to be in the mid to high range, and we're just going to go with CMG today, which is Chipotle. It's trading at just over $52 a share. It has an IV rank of 41.4 and an absolute IV level of 29.9%, which is quite nice. So what we're going to do is go over to the trade tab and pull up a list of expiration dates for CMG, and we want to pick one that's between 30 and 60 days out in time. Ideally, we want it to be a monthly expiration date, not a weekly or a quarterly. So we're going to go with April 17th, which is 55 days out, as you can see. So we're going to open that up, and now we can see the options chain here. And very simply, we have calls on the left, puts on the right. The horizontal orange bar shows us where the price of the underlying currently is. If you look in the top right, we have our IV level 31.2%, and in parentheses next to it we have our expected move, which is plus or minus 3.65 over the next 55 days. That's also visually displayed by this vertical orange bar, and these dotted blue lines are our standard deviation levels. So seeing as CMG is near its 52-week lows right now, we're simply going to be selling a put contract, and when you are selling a contract, you want price to stay away from that contract. You want the contract to stay out of the money. So if we sell a put, we want price to stay above that put. So what I like to do when you're just taking one side of the trade, like we will be in this example, I like to be around the 30 delta level. As you can see, we have our delta column here. So we're just going to sell this put at the 30 delta, which is at the 50 strike, just like that. And that's basically the entire position. It's very simple, however the mechanics work. So if we look at the numbers here a little bit, we have our mid price here at $1.18, so we'd collect $118 up front as soon as this order gets filled. We want price to stay above 50. Our break even actually would be 50 minus $1.18. So whatever that works out to be, $48.82. That's what our break-even level would be. We don't want price to go below that, otherwise we'd start to make a loss. And we have our pop here, which is 72%. So that's our probability of profit. So we have a 72% chance of making at least 1 penny on this trade at expiration. And if we don't hold till expiration, say if we get out at 50% of max profit, we have an 84% chance of being able to do so at some point over this next 55 days. So we're looking at between 70 and 85% chance of success here, which is a very, very high probability trade. This is before taking into account that implied volatility is generally overstated compared to actual volatility. This is before making any adjustments. So in reality, your win rate would actually be higher than this. So we would collect $119 up front. That's our max profit, and our buying power requirement is going to be $800. So we're making a respectable return here. This isn't going to make you rich overnight, but as you can see, we're getting a healthy return, and we are getting very high probabilities of success. If you did want to increase your return, or if you didn't want to allocate $800, what you could do is use some of your premium to buy another contract to cover your short further out from where your short strike is. Say if we just go $5 wide here at the 10 delta, we pay 31 cents to buy the 45 strike. And now what's going to happen is our buying power requirement is going to reduce because our max loss has reduced, because this is now a covered position or a defined risk position, whereas before it was an undefined risk position. So our max loss is now calculated by taking the spread, which is $5 minus our premium, times by the contract multiplier, which as we get $411. That's what our buying power requirement is. However, now what we do have is a higher return on capital but slightly lower probabilities of success, only by a little bit, not by much. So if you really did need to conserve your buying power, you could do that. However, I think for most portfolios, $800 on the naked position would probably be fine. If you would like to know how much buying power you should be allocating to your positions, we've created a free position sizing template. The link is in the description. Just click the button and it will take you over to the spreadsheet. The way it works is you enter in the size of your portfolio. So say if it's $25,000, you can then enter in whatever the current VIX level is. So say if it's 32.6, and then everything's going to be calculated for you. All you need to do is just use this information to form the backbone of your portfolio. For example, in this portfolio, for a defined risk position like what we just had a look at, you would want to, the maximum you'd want to allocate to any single position would be $1,250. In this example, only $400 was needed for a defined risk position. In an undefined risk scenario, we could allocate up to $1,750. However, this position only used 800, or a little bit over 800. So as you can see, you can structure your portfolio properly. As long as you're following this, you'll be absolutely fine. If you do want to learn in more detail about what we do and how we do it, again, the link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you will have access to one of our portfolios that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you do ever get stuck at any point, you can just speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee. So once you have been through the full course and followed some of our trades for at least 6 months, if at that point you are not profitable, then we will work with you for free until you are, or you can just simply request a full refund. So it is completely risk-free. It's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill so you can take it with you for the rest of your life. No one can ever take it from you. And we aim to get you to that point within 6 to 12 months. You're always welcome to stay and be a part of the community. But within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.